Hello everyone and welcome to another accounting video. So today we're going to go over bad debts expense. So remember I said accounting is all about trying to say let's take a basic business transaction and find a way to represent it in numbers. And as we go on, we're going to complicate things and try and make them a little bit more real life. And one of the aspects of real life is the unfortunate event that sometimes people don't pay you what they owe you. For example, say someone owes you for a product you sold them, but then they go bankrupt, or maybe it's a company and it goes out of business, or who knows, a whole line of things could happen that would make someone not pay you. So the question is, how do we relate that in accounting? Now, one option that pops into a ton of people's minds is whenever we figure out that something is uncollectible, we'll lower accounts receivable and then maybe make it some type of expense. And that is incorrect because of this. What happens here is if we were to do that in accounting, the income statement, the balance sheet, everything would become very volatile. And what I mean by that is if every time we learned that someone wasn't going to pay us, we added expenses, depending on the time of year and depending on, maybe say the customers we choose to collect from or do business with, the expense section of the income statement can become very big or very small, meaning net income and therefore retained earnings and a bunch of other things, your accounts payable, not accounts payable, but accounts receivable, that can switch up and down really quickly, and that's really not useful to investors. So what we found out as accountants, we said, well, how about this? Maybe at the beginning of a year or beginning of a period, we'll estimate how much of our accounts receivable is uncollectible. And then we'll expense everything at the beginning of the year and show that number, so therefore investors realize, okay, they're expecting not to collect around this much. So how do we record that? Well, let me just start. My assets equal, assets equal liabilities plus equity. And normally when you sell something on account, let's say you sold services. Let's just keep it simple. And it's $100 worth of services, but they said they'd pay you later. Well, we do $100 accounts receivable, and then over here we do the $100 revenue. Well then, let's say at the beginning of the year, so we have an accounts receivable amount and everything, and then we realize, some of this is probably going to be uncollectible, but we can't, write it off at any time. So at the beginning of the period, let's say that we assume that, with some method, and I'll get into the methods later, we assume that $20 is going to be uncollectible. And there's a couple different ways you can choose to do that. But I just want to get the basic mechanics of it down right now. $20 is going to be uncollectible. So at the beginning of a year or period, figure out how much is going to be uncollectible. So let's say, example, $20 is uncollectible. So we would have -20 allowance for doubtful accounts, and then, over here we'd have -20. This is called bad debts expense. And what this negative here in the assets, you're thinking, negative asset, what exactly is that? Well, here's the deal. Remember, the whole point of this is we're saying some of our accounts receivable is not going to be collected. So it wouldn't really make sense to call it a liability. We don't owe anyone else anything. It's just what we expect, this accounts receivable up here, we actually expect it to be less. And at the same time, though, it would be very useful for investors to know, instead of just decreasing accounts receivable and doing bad debts expense, it'd be very useful for investors to know, well, how, hold on a second, how much of this accounts receivable is from just normal business transactions, and how much less of it is due to specifically allowance for doubtful accounts, us not expecting to get the money. So that's why we make this account right here, allowance for doubtful accounts, and this is called a contra asset. And all that means is it doesn't exist by itself. All it is some sort of valuation account, an account that's supposed to take another account down to a more realistic value. So right here, $100 accounts receivable, that is unrealistic because we're not expecting to get all 100 of it. So we have this negative 20 allowance for doubtful accounts, which means we are expecting to get $80. So that's pretty much what we're saying here. And so again, at the beginning of a period, we'll do some method, and I'll get to that soon. And the method will say, hey, $20 will be uncollectible. So it's quite literally negative allowance for doubtful accounts, negative 20 bad debts expense. And what I'm trying to get at here with this negative is this allowance for doubtful accounts is a natural negative number because it's paired with accounts receivable. So 100 plus the negative 20 is meaning we're expecting to get 80. So we have this, and then throughout the year, we write off the allowance for doubtful accounts as we figure out that things are uncollectible. Because remember, this right here is just an estimate. We used a method to estimate that $20 is going to be bad debts. $20 is going to be uncollectible. And then we did that at the very beginning of the year. So then what happens is throughout the year, we could get more in accounts receivable, meaning we expect to get more. But also we could figure out, hey, things like, in reality, specific things start becoming uncollectible that we know of. So for example, $5 of services are deemed uncollectible. So all that means is we actually had, say someone owed us $5 of services and they went bankrupt and we can't get that from them anymore. This was just an estimate at the very beginning of the year how much will be uncollectible. This is us figuring out throughout the year, oh, so this actually happened now. So then what we do is now we'll subtract $5 from accounts receivable and then add $5 to the allowance for doubtful accounts. And so since we're adding it, that means this negative 20 goes to negative 15. And again, the whole reason we're doing this right here, accounts receivable goes down, the allowance, you add to it, which since it's naturally a negative account, it means it's sort of decreasing it. And the terminology can be weird, but we're overall making the allowance smaller. It just happens to be that we're adding a positive to a naturally negative account. So that's what's making it smaller. And again, the reason we do this is, as you can see over here, no expense is recognized when we figure out that specific items are uncollectible, because we already have all the expense up here. Now, here's another issue though. Let's say that throughout the year, then another $20 is deemed uncollectible. Then we do the same thing, minus 20, accounts receivable, add 20 to allowance for doubtful accounts. But as you can see here, that was plus 5, plus 20, plus 25. We only estimated $20, which would mean at this point in time, we have a positive allowance. which, it's not that that's like impossible or anything. It's just know that if you ever see a positive allowance, that means that throughout the year it was added to in such a fashion, all these positives are being added to it, that it just means we did not properly assume how much is going to be uncollectible. And it has an unnatural positive balance, which means depending on the method we use to calculate how much should be an allowance for doubtful accounts, that means that we could have different numbers and different updates when the year end. Because again, we initially do this, the initial adding to the allowance, or making the allowance exist, I should say. Again, adding, subtracting is weird words. So I guess you could say we have bad debts expense, which makes a bigger allowance at the very beginning of the year. And throughout the year, all we do is we make the allowance smaller. Sometimes we make it so small that it goes in the opposite direction and it turns from its natural negative account to a unnatural positive account. So that gets us to the question of, I keep on saying, hey, blah, 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 I'll tell you the methods later. Basically, there are two methods to figure out how much should be in your allowance account and how you keep track of it. Both are intertwined. So two methods. One is the easiest method, and it's just percentage sales. And this is exactly what it sounds like. You take the percent that you deem that you think will be uncollectible, and that's really just based off of management. Management may say, hey, 5% of the sales that we have that aren't paid to us in cash, they're going to be uncollectible. Obviously we don't want to add the the sales that are in cash because we already have that money. So we say percent of net credit sales. Sales just means, again, credit on account, sales that we did not get cash for immediately. And again, the percentage as the number will just be given to you because it's a management estimate. So an example would be management says, 10% of this year's sales are uncollectible. This year's net credit sales were, $1 million. Again, net credit sales, not total sales, just the sales we didn't receive cash for. So in that case, our bad debts expense is going to equal, 1 million times 10%, or 100,000. And then in our accounting equation, we're just going to have, a negative 1,000 allowance for doubtful accounts, and then over here a negative 100,000 bad debt expense. And that's all you do. And here's the thing. What I mentioned earlier with, hey, sometimes you could have a unnatural positive account because of actions throughout the year. You just don't take that into account. So if, let's say, you had a beginning balance of an unnatural, $5,000, then you're going to add, or I shouldn't say add, then you're going to have a bad debts expense, which takes it back in the natural direction, makes it bigger, of $100,000. Then that means the allowance at the beginning of the year, so I shouldn't really say this is the beginning balance, this is the ending balance year one, is going to be, an unnatural $5,000. Then at the end of year one, you do the calculation. So then at the beginning of year two, you're going to have not $100,000, but, but $95,000. A natural negative $95,000 in the allowance account. Again, because all you're doing here when you're figuring out what your bad debts expense is going to be is you just say, hey, what's percent times net credit sales, $100,000. This is the entry, and we don't adjust for how much we have in the allowance account prior. It could be this is the beginning of year 2, and at the end of year 1, we had some number in our allowance account. It doesn't matter. We don't adjust for it. All we do is just this entry, and then the actual amount we have in our allowance account, that's just adding together whatever the number is that you have. The ending balance of the prior year plus what you're adjusting for this upcoming year. Now, the second method, which is a little bit more complicated, is the accounts receivable method. And the accounts receivable method is normally done with an aging schedule. So all that is management will say, well, how about this? Accounts receivable that is 3 days past due, we still have like an 85% chance of getting the money. But any accounts receivable that is more than 3 days due, we only have a 40% chance of getting the money. And then all you do is you multiply the numbers across, and then you figure out, hey, this is the total amount that should be the allowance for doubtful accounts. Again, the first method, the percentage of sales, we're finding what the bad debts expense should be. And we care about the expense. It's an income statement approach. So, and then the allowance just follows suit. We're doing the opposite with the aging schedule, the accounts receivable method. We're trying to figure out how much should the allowance have in it, and then we'll adjust what our bad debts expense should be. So let me give you an example. Let's say, let's just keep it simple, which is greater than 3 days due. We have $10,000 of accounts receivable. We have an 80% chance, and then greater than, so let's make this logical. Less than 3 days due, we have an 80% chance, but if it is greater than 3 days due, we only have a 40% chance. And let's say there's $20,000 that, and again, this information will just be given to you or easily found. How much of our accounts receivable is more than 3 days due compared to less than 3 days due, and what is management's percentage estimate of how much will be collectible. So then you just multiply across, then you add them together, and bam, this is the total amount that should be in the allowance. So we do this aging schedule, just do the simple math, add up the bottom column, and bam, bottom rows, and this is the total amount that should be in the allowance. So example 1, we started without an allowance account. If we started without an allowance account, then that means we have nothing in the allowance, which means it's simple. It's like the percentage sales again. We just have negative 16,000, negative 16,000, and the allowance for doubtful accounts, and then negative 16,000 in bad debts expense. Bam. Now, let's say, though, we started with a natural negative 3,000 in the allowance account. So that means that last year we estimated some bad debts expense and some allowance, and then throughout the year we took away from the allowance as we figured out specific things were uncollectible. That's what, let me see, this process is all the way up here. as we figure out specific things throughout the year uncollectible, we'll decrease accounts receivable and then make the allowance smaller by adding, a number to a naturally negative number. Anyway, but let's say we didn't use all of it and we still had the natural negative 3,000 in the allowance account. Well, we only need 16,000. We already have 3,000, which that means we only need to do a 13,000 entry. And then over here, negative 13,000. Bad debts expense. And then example 3, we overused the allowance last year, and we have an unnatural positive 2,000 in the account. Well, we have an unnatural positive 2,000 in the account because we overused it last year. We didn't estimate properly. Well, the allowance needs to be 13,000. So it's actually, the allowance needs to be 16,000. We did that math up here. Well, in this case, if it needs to be 16,000, we have an unnatural positive, then that means we're actually going to have 18,000. The allowance for doubtful accounts, 18,000, and the bad debts expense. The 16,000 we need, and we need to chip away the 2,000 unnatural positive. 16 plus 2 is 18,000. So that's the third option you could run into. And again, you only do this game of adjusting for what you need in the allowance account in the percentage of accounts receivable method. And normally the accounts receivable method is just an aging schedule. Sometimes in problems, whether it be on the CPA or wherever else, tests or something, they won't say we used an aging schedule. They'll just say, hey, we did an accounts receivable method and we found out that this number or something like that is going to be uncollectible. And then that just is good. That just means they did the math for you. And you just didn't have to do that to find this number right here, which is the amount that should be in the allowance account. And again, this would really be a negative 16,000, I guess, if we wanted to be really proper, the amount that should be in the allowance. But anyway, again, in the percentage of sales method, you don't adjust for what you have in the allowance account. You just do a percentage of net credit sales and make that the entry. And then you just sort of have to figure out, okay, so how much do I actually have in my allowance? You just take what we had at the beginning plus your addition, subtracting what you're making the allowance bigger by, and that's going to be your true allowance. So that's the situation, and thank you.